OG John AG here, and what we just witnessed was a massive reversal. Gold has surged over 11% off the bottom and is now back above 4,880, adding more than 3.07 trillion in market value in just 30 hours. Silver has ripped nearly 20% higher, reclaiming the 88 level and adding another $800 billion in the same time frame. That's almost $4 trillion recovered in 30 hours, roughly 35% of the entire $11 trillion wipeout. And here's the part most people are missing. This $4 trillion snap back while retail investors were panic selling. This is exactly what forced liquidation looks like on the way down, and a short squeeze looks like on the way up. The volatility isn't the danger. The volatility is the opportunity. Gold back over 4,900, silver back over 88. A violent shakeout from all-time highs, and metals just added over $4 trillion in market cap almost overnight. Now go check my X account. I posted hours ago about the consequences this channel would face after exposing JP Morgan's planned crash. Since that video, viewers are being unsubscribed and copycat channels are exploding, stealing our titles, thumbnails, and analysis word for word. Every time we post, within hours the clones appear. Why? Because OG is the source code. Without our research, hundreds of these channels wouldn't exist. But Team OG stays on top, unbiased, researched, and straight to the point. We're bullish on precious metals, but we're not blind to the manipulation running this system behind the scenes. If you want hype, go watch the channels recycling our content. This channel was built on education and unfiltered truth. And we're not backing down. We have never asked for money and never will. Anyone pretending otherwise is a scammer. Our only official handle on YouTube and X is OG John AG. Now here's why this $4 trillion reversal is even bigger than it looks. Another 2.8% of silver just left the vaults in a single day. The drain is accelerating. And while this is happening, China just revealed its endgame. The Chinese central government released an article by Xi Jinping on building financial power, and the Chinese version tells a very different story than the English one. It lays out 6 core objectives, with a powerful currency as the #1 priority. And the foundation of a powerful currency? Gold pricing power. Becoming the world's top producer, consumer, importer, and holder of the largest gold reserves on Earth. This wasn't some blog post. It was published through official state channels, the financial equivalent of a military parade, a clear signal that China is nearing completion of its preparation. Their gold reserves will underpin the internationalization of the yuan. The global gold endgame is approaching. Gold defines the value of currencies and the future monetary order, and China is positioning itself as a dominant force in that final battle, and the data proves it. China is buying 10 times more gold than it officially reports. In November alone, they bought 10 tons while reporting just 0.9 tons. In September, they acquired 15 tons while disclosing barely a fraction of that. They're stacking quietly, publishing minimal numbers while building massive real reserves behind the scenes. Now look at pricing. Western spot silver, $88. Shanghai spot, $14 higher. Shanghai futures bounced to 102 from 95 premiums, are still around 20%. Even after a brutal crash and bounce, physical metal continues trading well above paper prices. And that's the key. The screen price is paper, leverage, derivatives, speculation. The real price is what it costs to actually get metal in your hands. That's why people in Singapore are lining up to buy gold even as prices swing wildly. Because smart money understands what just happened. This drop wasn't natural, it was manufactured. Big players flushed the crowd out and quietly accumulated at the bottom using algorithms and volume traps. Retail panic sold. Institutions and central banks bought the dip, exactly as they always do. And now the reversal is exposing it in real time. On Monday, retail investors flooded United Overseas Bank, Singapore's only bank offering physical gold. Even as bullion prices were crashing, people were lining up to buy the dip, showing that the real drivers behind gold haven't changed. This wasn't fear, this was conviction. Sharp declines weren't scaring buyers away. They were pulling physical metal into private hands. And look what happened next. Gold is now up nearly $500, about 9%, back near 4,900 from the lows. At the same time, paper market activity exploded. The silver-backed ETF SLV recorded a staggering $41 billion in trading volume on Friday, more than any stock on the planet. That isn't retail behavior. That's institutional panic and repositioning. The paper market went insane, while physical buyers calmly queued in Singapore. Meanwhile, all the banks managed to do by slamming silver lower was shave just 5,000 to 6,000 contracts off CME Silver Futures open interest, now sitting near 142,000 contracts. For perspective, during the 2011 silver squeeze attempt, open interest was over 250,000 contracts, and volatility exploded. So for anyone claiming this move is retail-driven, the data says the opposite. Retail panic sold the bottom. Institutions and central banks bought it. and the proof is simple. Retail doesn't move $4 trillion in 30 hours. That's sovereign wealth funds. That's central banks. That's China executing its gold strategy while paper markets implode. There is now a full-scale race between the U.S. and China to secure scarce gold and silver. The U.S. government just announced a $12 billion critical mineral stockpile, funded by government loans and private capital, an explicit move to counter China's dominance. They're securing hard assets before currencies lose value. When governments start hoarding metals, they're sending you a message. And the physical shortage is already here. Major dealers are running out of 1,000-ounce silver bars. Vaults just drained 2.8% in a single day. Physical premiums remain elevated. $4 trillion recovered in 30 hours. China buying 10 times what it reports. Physical disappearing. The squeeze is real. And it's only beginning. Margins were raised to stop the rally. Prices were slammed to break momentum. And yet metals ripped higher anyway. The banks are trapped. Now there are real risks. And we need to talk about them. Japan's 30-year bond yield just hit the highest level in history. Japan is sitting on the worst debt crisis of any major economy, with debt at 250% of GDP. The U.S. is already stretched at 120%. Japan also owns $1.22 trillion in U.S. treasuries, more than any other country. For decades, investors borrowed at near zero rates in Japan and bought higher-yielding U.S. bonds, the famous carry trade. But now Japanese bonds pay nearly 3.7%. The free money is gone. There's no reason to send capital to the U.S. for tiny returns while taking currency risk. That means hundreds of billions, potentially over $1 trillion, could flow out of treasuries. When demand falls and supply rises, yields spike. When yields spike, markets break. We already saw over $1 trillion wiped out in stocks in days. The Treasury Secretary is calling Japan directly. The Fed is stepping in to stabilize the yen. The dollar just dropped at its fastest pace in 2 years. This is systemic stress. And that's why metals were hit first. Forced liquidation, margin calls, paper selling. But once that pressure eased, the real bid came roaring back. Central banks buying, China accumulating, physical scarce, and suddenly $4 trillion snapped back in 30 hours. That's what happens when fundamentals overpower paper manipulation. Now here's the bigger picture. The stock market is entering its final bubble phase, incredibly concentrated, more top-heavy than ever before. When this cracks, money doesn't flee to cash. It flees to real assets, gold, silver, strategic commodities, and that's exactly what we're watching begin. Can gold retake 5,000? Can silver challenge 100 again? With vaults draining, physical premiums holding, China buying aggressively, and institutions repositioning, the momentum is shifting. And the wild card is China's gold reserve reveal. Xi Jinping's official article made it clear. Gold pricing power equals currency power. China has been accumulating quietly for years. If they announce reserves 10 or 20 times higher than reported, the gold market reprices instantly. Every central bank will scramble to buy. That would be the trigger for a global reset in precious metals. So here's where we stand. $4 trillion recovered in 30 hours, proving the crash was forced liquidation, and the rebound is institutional accumulation. Physical demand never left. Singapore queues, vault drains, dealer shortages prove it. China is executing a long-term gold strategy while the West watches paper volatility. Governments are stockpiling metals ahead of currency stress. At the same time, Japan's debt crisis and treasury market stress are real risks that can create more violent swings. The paper market creates chaos. The physical market creates the floor. Know which game you're playing. Short-term volatility will be brutal. Long-term fundamentals are screaming higher. Do your own research. Understand the risks. Don't follow hype. But don't ignore what the smart money is doing right now either, because this squeeze is only getting started.